Hello and welcome back to another mediocre lesson on a mediocre Friday. Um, Going to kind of redo my stock lesson. Um, I didn't love it. I know this is mediocre lessons. I don't do a plan, but I don't feel like I've gotten into the very beginning of what a stock actually is. And I think if I am not informing people to the fullest at the beginning level, then this is a complete failure, even at the mediocre attempts. And so I have to do better. So I'm gonna do a really deep dive today. It might take a long time, might not be a 15-minute video. If you watch the last one, this is gonna be there's gonna be more information. You definitely might learn something, but overall, I would probably you know not worry too much about it. It's going to be much more about the very beginning of what a stock is. And without further ado, let me go ahead and pull up my Fidelity webpage to because they are one of the biggest companies in the world now. That wasn't the case literally a year ago. They were half the size. Look at these returns. In 1 year, they were 130% smaller, right? So um, look at their mega cap. So they're around 1.2, $1 trillion a year ago, and everyone was like, "What? Nvidia is $1 trillion? That's stupid." Yeah. Well, now who's stupid? So it's so hard to understand how to make value out of companies. All right, but let's start from the very beginning. Okay, what is this? First of all, companies run the world, right? We all are consumers, and we need things to be able to survive. And we have companies that produce those things. You have public companies, you have private companies. Private companies are funded by banks, and then private investors, investment companies, like they have access to all these investments, like hedge funds and things. Vanguard, Fidelity, they have access to like bank loans that they use to help fund companies like Nvidia. And they have access to things like bonds that we've already talked about, where they can go and buy, $100 million of debt basically in this company with a priority, and they can fund them. And so companies also, that's the debt side of the balance sheet. The liabilities is bonds, bank loans, things like that. Anything that you have to any borrowing of money, and then we have the equity side. And the equity side of every balance sheet, you're going to see the ownership of like what besides what the debt is owed, how much ownership there is for people or investors, basically, not people specifically, but investors. And so you have public and private companies. Public companies are the ones that we have access to as regular retail investor, as they call us. And what we can do is we can go and trade on exchanges through brokerages like Fidelity, Robinhood, Charles Schwab, E Trade, whatever it is. Your banks do it. You go and you trade on an exchange, the New York Stock Exchange, the NASDAQ, just basically an open market where people accept either basically you're accepting money for equity or ownership in companies. And ownership in companies is broken down in per share value. So each company has a total amount of shares outstanding, right? Nvidia's is 24.6 billion, right? Eight zeros. Nice. Yep. So 24.6 billion shares outstanding. So if you want one share, which is $107 point whatever and some change, um, you get ownership in that company. Very small piece, not even like 0.101 of a percent. Very tiny. Um, you are going to then have ownership of that company, right? And so we have public and private companies, and the way private companies offer their equity, the ownership in their company to the public is they go through what's called an initial public offering. And so you IPO for short, a lot of acronyms in the stock market, but IPO for short. And on the initial public offering, they go and they open up the market and they say, this is what we think the company is worth. And then there's basically an argument all the time of financial institutions and retail investors trying to decide what the exact value of this company is at that given moment. Obviously, that always changes because information's coming in, things change, sentiments change, all we do to price in these valuations change. But when they first come public, they come public with a ticker, which we see as NVDA, a symbol of letters, a combination of letters to make up their exchange name, basically. So the way in which they're identified on the exchange, the ticker is an identifier. So NVDA, you'd go and try to purchase a share of NVIDIA on the initial public offering, just for example. And that's basically how it works. Okay, so kind of fumbled around that a little bit maybe, but basically private companies go public with IPOs and they are trying to be valued by the market, considering all their things, financial statements, everything that goes into what a company actually looks like in the future. Of course, you have to try to price in what's going to happen. And then you take the shares outstanding and you times it by the price, and that's how much the market cap or value of the company is. So if you take 24.6 and times it by 100, you kind of see it works. It's 107. If you just did 100, it'd be 2.46 trillion dollars worth. And in this case, it's 107. So you just like a couple extra 100 billion, no big deal. Right. And so that's basically what happens. And like I said, there's constant argument of like, what is the right price to be paid? And so there's always a bid and ask price. I don't know if you can see it. Yeah. So we have a bid and ask price. This is I can break this down too really quick. The bid is basically what the buyer, buyer, is trying to give for the value of the company at this given moment. And this is the best price with the most shares. So somebody currently will pay $106.72 for 2 shares. Market price probably went down after hours, so you probably just can't see that. And then the ask size is what any seller, so you have to own a share of the company, is willing to accept for that price. Okay, $106.73, and they're currently trying to sell 15 shares, and that's the best price you can get right now. So, and this price of the day, these kind of things I think are pretty straightforward. Volume is important. Basically, what volume is just how many times a single share of the company changes hands, buying or selling. It doesn't get specified in this. Essentially, it's always both. There always has to be like an agreement, right? Somebody wants to own it and somebody wants to sell it. And so it doesn't really specify like what the orders are, because somebody on the other side is saying like, okay, that's fine. Like that's a good deal for me, right? Always. Whatever's happening, the other side always thinks they're doing a better decision for themselves, right? You're not going to like freely give away your money. So the volume is just how many times a share changes hands. Like somebody sold it and somebody bought it 482 million times today, shares of NVIDIA stock. This is just breaking down the averages of how much volume it is. So like this is just a more active day and it was a red day. So like more people were trying to sell today. That's kind of an assumption you can make on the volume. That's it gets complicated with that, and I don't want to be too messy. So that's basically the beginning of it. You own a common stock of company. You're trying to hope that that company increases in value and that share will always increase. And then it goes down when the sentiments change, all the valuations in it. The valuations are very complicated, so I don't think it's time for me to try to show any kind of like methodology for that. But yeah, essentially that's what my thoughts are with that part. Let me just think a little bit, make sure I covered all the basics there. Yeah, and then I already went into the dividend and things like that in the last video. So I just wanted to make sure I covered that front part because it's so important that you understand, like, it's just a share that you're paying a price for. I did want to mention one thing on the IPO is that when a company goes public, they're offering these shares. They're offering the shares to the public in a set number, and then that always changes a little bit because they can, buy some shares back and things like that. But that's kind of an important note. Like we were talking about bid and ask, so the buy and the sell price. But in the beginning, what's really happening is that all those shares have to be sold to the public first, right? And then it becomes the secondary market. And so when you're IPOing, you're really kind of on the primary market because it's the first time that you're going out and actually just finding a seller. There's not, you're just going to find a buyer. There's not technically a seller besides the company. Just not to get too deep into it. Okay. And then we already talked about the dividend and stuff in the last video, so I'm not going to get too deep into it. I do want to get into a concept about it though. Basically, what you're doing when you invest in a company is you have those two hopes, and I might have covered this now to say it, but you have hopes that you're going to increase in value, and you're going to do it realistically two ways. There's only two ways to gain value when you have an investment. It's either going to increase in price or you're going to receive a payment from it that's going to give you your money back in time. And that's exactly what happens. So you either, in NVIDIA's case, the stock has, doubled in a year. So you already got your money back, right? If you've invested in it this time last year, you've doubled your money. And then we can daydream about 5 years ago and things like that when you 25x your money. But what you're doing is you're either going to increase your value through capital gains or unrealized capital gains, because you have to sell it to actually have to owe taxes on it. But the value is always there. You can go and get it anytime because the market's liquid as possible, right? You can go and buy and sell instantly whenever for pretty much any stock. So your price increases or they pay it out through dividends. So somebody like AT&T who's paid like 5% dividends for 20 years, they are going to pay you your money back over the lifetime. It just takes a lot longer. You do have an opportunity to see gains as well through capital gains. So that's why people approach dividends with the mindset of like, oh, I can also make more money because they're going to pay me and they're going to also increase in value. But when they pay their investors dividends, when companies pay their investors dividends, they're giving away their earnings to appease the people who, want them to perform really well. So they're not able to reinvest that and like go do more research and development or marketing, so or hiring more people, right? They might do layoffs because they don't want to cut their dividend. And I've also seen in today's society, you'll see companies that will go and take debt out just to pay dividends, just to like keep that flow of earnings going, to the investors, just to make sure everyone is happy. Because when they cut those dividends, it's huge problems for the investors, and they're all going to sell, and that's going to decrease the demand from buyers, right? So it's just supply and demand. Also, something I want to touch on, just a basic economic theory of like when there's a bunch of supply of people wanting to sell their stock, then the demand goes down and the price goes down. And we see that across all investments always. Like when the demand for something goes down, the price is going to decrease, and then your yields go up. So like on the fixed income side, don't want to get too far into it, but like when the prices go down, the yields go up. And when the prices go up, that means there's a higher demand for it. So the yields go down. So you'll see that in the market currently. Anyways, so when you see that companies are paying out dividends, that means they're giving away earnings. So NVIDIA doesn't pay dividends, right? Because they are super focused on this hyper growth company. And that's where you get these kind of growth That's where you get the big rewards as well. I mean, if you really would have shot your shot, you would have been successful pretty much anywhere in the last 1 to 5 years in NVIDIA. So that's great. I've already gone over the mega cap. There's caps. So market cap, and then there's categories. There's small, medium, large, and mega cap companies. And it's just a breakdown of like how valuable they are. You see the most growth in like small and medium companies because they're smallest. So obviously they have the most opportunity to be huge. You're not going to see Apple, 2x. It's going to take 3, 5, 10 years, but someone like GameStop, who's much smaller, has the ability to be manipulated by huge demands because their stock price is so small. They can be manipulated by really huge hedge funds making large positions on them and having to go out and buy a bunch of stocks when they're getting shorted or something. And that's another point of the like value of a company. Basically, when you think about like increasing the value of this company, you have to have people demanding it so much that when you think about $2.7 trillion is huge, right? So that's going to be a whole lot of people pushing this. Like it takes a lot of people to make that decision, to be collective on it. And nobody has that much money, right? Like it's too much money for them to be able to manipulate it fiercely like that. Obviously, a collective, bunch of institutions can move a price, but when you're talking about something like a small company, GameStop, Chewy, these multi-billion-dollar, like $10 billion companies, that's not that much. I mean, it is obviously a lot to anyone who ever sees this, but it's not that much money when you think about the collective. Like that's not even a percent of NVIDIA, like NVIDIA should be able to just go and like basically buy like 3 GameStops and they can triple the price basically because of that huge demand. Just kind of a little tidbit there on like how the pricing works, because basically people do manipulate the market, not people necessarily, but companies, because if Vanguard decides to take a 10% stake in a company, that's going to be a lot of money and a big movement in that stock price or something. So that's it with that. Price performance it's kind of basic. I did want to get into technical analysis, but I don't want this video to be so long. I can already tell it's boring. Like it's just so hard to be entertaining, but it's just, stocks, stonks. Yeah, we could get into it, but I don't think that stuff's important. I don't know if I talked about splits last time, but I did. I talked about it with Apple, and I went into the finance stuff, the sheets. So I think I'm going to leave it at that. I just wanted to cover the basics. I feel like that was the real bottom line there, and keep it short and sweet. And maybe next time we'll get into technical analysis or something. But I just want to shout out my fan that came by. Thank you, Charlie. You a big fan of you. Rock on. Thanks so much for watching, and happy weekend.